New requirement in the Secure Act 2.0 gives you less flexibility, forces you to make contributions to your 401k in a certain way if certain conditions apply. Very confusing. I'm going to explain that more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so the Secure Act 2.0, done a lot of videos on it, doing some talk shows about it. So it's going to impact your financial life. It's going to make changes. The question is, should you also make changes? Do you need to be aware of these changes that are maybe being forced on you? Or with new choices, should you make different choices? And that's the thing. I don't like the complexity that the Secure Act 2.0 is bringing. Very, very confusing rules. We're going to talk about one right now. I do like choice, though. I do like choice. Financial planning and being proactive with your finances is all about making sure that you have the most options available to you so you're not sort of painted into a corner. But then you need wisdom applied to your financial life so that of those great choices, you know the very best one. You know the very best one. How do you do that? A comprehensive approach to your financial life, looking at all 6 areas so that you look at each choice under the magnifying glass to say, how's it going to impact this area? How will it impact my taxes? How will it impact my estate plan? How will it impact my retirement? How will it impact my investments? And oftentimes you can clearly see of those great choices, which one or two are the very best, and you can narrow down your search, and there you have it. Secure Act 2.0, great, gives you a lot more choice if you can understand the rules, but there's a couple where it removes choice. And one in particular that's very confusing, I'm going to try and clarify right now. All right, so we know that once you turn age 50, you can contribute even more to your 401k, even more to your IRA and Roth. We're going to talk about 401k through what's called a catch-up contribution. Okay, that catch-up contribution, the year you turn age 50, your maximum contribution to the 401k this year is $22,500. But you can also do a catch-up contribution. You can do even more in the year you turn age 50, and that's $7,500. They've added in, not the purpose of today's video, but they've added in a new catch-up contribution when you turn age 60, and that only applies for age 60, 61, 62, and 63, and that limit increases that $7,500 catch-up to 10 grand or more, and it's likely to be more. But here's the confusion. Yes, that is confusing, but here's the rule that is creating even more confusion and restriction, and that is, if you earn more than $145,000, if you earn more than $145,000, now we're not talking about your taxable income, your overall income, all sources of income, it's just through your employer, just through your paycheck. If you make more than 145 grand, your catch-up contribution must be into the Roth side of your 401k. That's a new requirement starting 2024. It must. You will not have a choice. If you want to do a catch-up contribution, you cannot have it go in pre-tax. It needs to be to the Roth side of your 401k. Some of you say, well, great, I was going to do Roth anyway. I'm in the 22% tax bracket. I'm very comfortable paying tax at that rate, and I'm willing to pay tax at that rate so those dollars can grow tax-free forever. Fantastic. Others of you say, well, wait a second, I'm actually in a higher tax bracket today than I'll be in the future because I am making more. My household's making more. I want to have these contributions be pre-tax. I've talked long ago about the great strategy we've helped a lot of people with. Max out your pre-tax 401k and contribute to the Roth. Max out your pre-tax 401k and contribute to a Roth IRA. Love that idea, right? So if you've been wanting to do that or you have been doing that, this new rule says, listen, your catch-up contribution cannot be pre-tax. It's got to be Roth. So this rule is sort of the exception to a lot of the rules in the Secure Act in that it doesn't give you more choice, it gives you limitations. It's a restriction. All right, so here's where the confusion is. And we're actually going to look at an article that has screenshots of the actual language is, well, when do you know how much you're going to earn for that year? Well, not until the end of the year. So therefore, how can you know ahead of time if you should be contributing your your catch-up contributions pre-tax, or if you're going to be forced to make them Roth when you don't know how much truly you're going to make. And you might think, like some of us did, you might think, well, yeah, I mean, if I'm on salary or whatever, yeah, but what if you get a bonus? Or what if you're on commission? Or what if your base salary is really, really normal, but you change jobs, all that sort of stuff. So actually written into the rule is if you earned $145,000 from that employer last year, if you earned more than $145,000 from that employer last year, then you're going to be required to have your catch-up contribution be into the Roth side of the 401k this upcoming year. That hopefully clarifies some of the confusion, but there's 2 points that make it messy. And the first is, what if you change jobs? Taking a look at this scenario, we're going to link the article below as well, but taking a look at this scenario, based on how the language is written from Congress, we'll see how the IRS interprets it or if there's any clarification with this, but based on the language, it suggests if you switch jobs, it's very possible you could earn more than $145,000 between 2 employers in the previous year. But as long as your new employer, you earned less than $145,000 last year because maybe you only started that job in October, or you started it in July, or you started it in November, you earned less from your current employer. You earn less than $145,000. Therefore, the language suggests that even though aggregate you earned more than $145,000, not from that employer, and you could contribute pre-tax to your 401k for that upcoming year, for that current year. So we'll look to see if they clarify that, but that's currently how the language is written. And then the other confusing thing is, well, what if you're self-employed? If you're self-employed, you truly don't know how much you've earned until you file your taxes. And a lot of self-employed individuals extend their taxes. You get an extra 6 months. And so they're still sorting out, profit, income, expenses, profit, that sort of stuff. So you really don't know. And it seems to suggest that self-employed individuals will be exempt from this requirement to have their catch-up contributions be into the Roth side. Now, that seems bizarre to me. I wonder if they're going to say, well, it applies to certain self-employed individuals, but not these self-employed individuals. We'll see. But some experts that I've talked to, they don't suspect that this rule will apply to self-employed. So that would be a loophole. If you're self-employed, then this may not apply to you. All right, so the $145,000 income limit, that's last year's earnings with your current employer, with that employer, and that will influence whether you can make pre-tax contributions for your catch-up or if they need to be Roth. Here's why this is so important. Obviously, this doesn't apply if you're not eligible for catch-up contributions, and you're not eligible until you're 50. So if you're younger than 50, it doesn't apply, but it's going to be something you want to be aware of from a tax planning standpoint. But at age 50, 51, 52, 53, that sort of, you're hopefully in some of your higher earning years, so it's likely you may be influenced by this, but you also likely have some kids that are in college around that time. And there are tax credits that are available for college as long as your adjusted gross income stays below certain levels, the American Opportunity Tax Credit. I know a lot of people where there's a primary breadwinner and then spouse either works part-time or doesn't work because they've been raising kids and helping manage the family and all that sort of stuff. And so therefore, in that scenario, the primary breadwinner is making $150,000 or more, and they're trying to save or defer as much of that income landing on their tax return as possible so that they can maximize or get the maximum amount of tax credits, college tax credits. And if you're unable to have your catch-up contributions be pre-tax, if they have to be Roth, it's going to make it harder. It's going to make it harder for you to qualify for that. So therefore, you've got to look at other ways to get deductions, HSAs and other things you've got to be more sensitive to. So lots of planning implications here. So if you're age 50 or older, you need to be aware of this. It's prior year income, okay? If you switch jobs, there's some loopholes there. If you're self-employed, there's some loopholes there, but you've got to be planning for this. If you're not yet 50, but like me in your 40s or getting close, you're going to want to be aware of this so that as you do some multi-year tax projections or plan out your finances, you're aware of how this is going to work and you can anticipate or be proactive as to how you should play it. work with your certified financial planner. Again, guys, the need for planning has increased significantly. Comprehensive financial planning. This isn't planning that your investment only person is going to help you with, or the guy or gal that does your tax returns going to help you with. Someone that's orchestrating all of that, taking all of those pieces of your financial life and bringing them together into one cohesive plan. That's the job of your CFP, doing comprehensive financial planning. If you don't have that person on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.